All right, good afternoon, guys. So today we're going to talk about money markets. So your last two topics that we talked about was largely your capital markets, and it was for long term, right? Capital markets, and it was for long term. Yeah. So now we're going to see the other side of the coin, and the other side of the coin is called as money markets. Okay. Now, can anybody tell me what is money markets?
Money market is where the short-term securities are maintained day-by-day basis, immediately less than 1 year, like treasury bills and repurchases of agreement.
Okay, fine. So when we talk about money markets, right, basically it's for short-term lending and borrowing, okay? Basically less than 1 year, okay? It's basically less than 1 year. Now, can anybody tell me why, uh, so Shubham, it's maturity of less than 1 year, okay? So key point is less than 1 year, okay? Now, can anybody tell me why investors would want to invest in money market instruments? No, yeah. So working capital is what. So look, listen to my question. Why will an investor invest in money market instruments? Guys, that is you're all talking from company perspective, managing liquidity risk, working capital. I'm not asking that. Think, please. I'm asking why will an investor want to invest in money markets? No, higher returns are always going to be long term, and that will be through equity market. Okay, low risk, fine. That's an acceptable answer. Apart from that, okay, all right. Well, okay, it's fine. So, kind of close, right? So, why does money market exist? Is it's for investors who don't want their money tied up for the long term. Okay. Now, when you talk about short term, right, less than 1 year, your returns are not going to be high as compared to long term. Okay. Your returns are somewhere on an average of like 5 to 7%. That's it. Okay. But why would an investor want to invest in a money market fund? Is because they want to have their investments locked up for years together, right? Because see, when we talk about some of the finance money market instruments, so a lot of the money market, all the money market instruments, since it has a maturity of less than 1 year, right? What's going to happen is that uh, they can quickly invest their money, get a return, and get out. Okay. Whereas if they were investing in equity or fixed income, right, they have to wait for years and years and years to get some sort of return. Okay. Now, when you talk about money markets, right, who are the major players for money markets? Okay. So again, guys, one thing, please be specific with your communication, right? So when you talk about banks, is it investment banks also that play a part of role in money markets? Okay, so let's be clear: is that the money market space, right, is largely by retail banks, commercial banks, and central banks play a major role. Okay, these are the three main players within this money market space. Okay, retail banks, commercial banks, and central banks. Okay, central bank being RBI. Okay, in India. Now, when we talk about retail banks, who is the target or audience, or who is the target customer? Right, retail investors, individuals like you and I. Okay, and when we talk about commercial banks, who is it? Right. So generally corporations, right? Generally corporations will be your client base for commercial banks. Okay. All right. Take a second and write this down. Let me know when you're done.
Sir, what is money market space? What does mean that?
So money market space, meaning the market, like who are the players within the money market well, space, man. How do I say it? Uh, it's the same thing. Basically, who is in that money markets? Who are the players within the money markets? Does that make sense? It's like, when you talk about the equity space, right? You have retail investors, you have financial institutions, you have brokers, etc. But when we talk about money markets, the space or the people who are involved are largely your retail banks and commercial and central banks. Okay, everybody done writing? Okay. All right. Now, one of the most important things within the money market space is what we call as interbank lending. Okay, is one of the most important aspects within the money market space. Okay. Now, when you talk about interbank lending, right? Essentially, on a daily basis, a financial institution. Okay. Now, in this case, when you talk about interbank lending, even investment banks are involved a lot, right? So all banks at any given point by end of day, they will either have a surplus in their account or a deficit in their account. Okay, either a positive account balance or a negative account balance. Okay, now if a bank has a negative account balance, right, what will happen is that the bank will be charged overdraft charges, OD. Okay, the bank will be charged overdraft charges. So that is why they have to borrow that money of that deficit somewhere in the market. Okay, they have to borrow it. Okay, and what happens is the person who has excess money, right? they're going to allow you to borrow the funds, but they're going to charge you interest on it. Okay. Okay, is this very clear with everyone? Interbank lending is a major portion of your money market space. Okay, so you have various types of interbank lending, and largely why they do interbank lending is that on every single day, there is a there are banks that have a negative balance, and there are banks that have a positive balance. So what happens is that lending between the banks takes place. Okay. Now there are a few of them that you have to know. So, we had a question.
पेटीएम पे बिल जनरेट हो जाता है आप रिचार्ज करोगे ना तब बिल
Okay, I think yeah, just okay. Okay. So now let's look at the various types of interbank lending. Okay. So first one is you have call money. Okay, you borrow or lend for 1 day. Okay, and it can be returned the same day at any time. Okay. Overnight money is that you borrow today and you return it tomorrow. Basically, you hold the borrowed money overnight. And notice money is that you borrow or lend from 1 day up to 14 days. Yeah. And then term money is you borrow or lend from 14 days up to 365 days. And finally, you have weekend money where you borrow on Friday and you return on Monday. Okay. And intraday is you return the money by afternoon, 2:30 p.m. local time, pretty much all the markets in the world. So if you are, let's say, in Singapore, and you are, let's say, HSBC and I am Society General. So if you want to borrow money from me, so you can borrow it at 10 a.m., but you have to return it before 2:30 p.m. Singapore time. Okay, this is what we mean by intraday money. You have to return it before 2:30. Now, how is that different from call money? Is that you can return that money, or I can call the money back anytime throughout the day. So if you borrowed from me at 10 o'clock, I can ask you to return the money back to me at 11 o'clock or 5 o'clock or 6 o'clock, okay, whatever it is, okay. But I can call back that money anytime before the end of the day, okay. And overnight is you borrow today and return tomorrow. Notice is 1 to 14 days, and term is 14 to 365 days, okay. Is this clear with everyone? Okay. Now, I'll give you a minute. I mean, just give me 1 second. Let me finish up this part, right? So, why will banks do interbank lending? Does anybody know the answer? Why do banks do interbank lending? Mm, okay, interest is for the person giving the loan, but what does the guy who has negative balance? What does he get?
So is it the charge that you said earlier that when the other banks, I mean, they give a charge if they don't show a particular balance. So just to avoid that, they borrow the money.
Okay, so that charge is well, yeah, close to it. So what we call that's the overdraft charge, but in terms of a bank, right? It's no. You guys would have heard of the term CRR and SLR, yes? So you are right, short-term funding requirements, and mainly it's to maintain the CRR and SLR. Okay. Now, one thing you guys have to understand is that in India we use this term as CRR and SLR. Okay, but you have the same kind of ratios in other markets in the world. Okay. Now, as email homework. Okay, so I call this as email homework. Okay. Um, find out the various ratios of other markets. Okay, so find out for the US, UK, France, Germany, uh, India, why not? Okay, China, Singapore, Hong Kong, and Japan. Okay, now you might not have it for all the countries, okay, but you should have it for most of them. Okay, so like how in India we have CRR and SLR, same thing, you have to figure out for other markets. Okay, okay, is this clear with everyone? So US, UK, France, Germany, India, China, Singapore, Hong Kong, Japan. Okay, now when you talk about CRR and SLR, right, what is the difference between the two? Does anybody know? Okay, correct. So when we talk about CRR, right? So a bank, for example, HDFC Bank, have to maintain a certain percentage of their deposits with RBI on a daily basis. Okay. Now SLR is what the bank has to maintain for themselves. Okay. Now in CRR, the deposit obviously is in cash, so that percentage they have to maintain with RBI. Okay. And when we talk about SLR, right? The idea is that the bank should maintain liquid assets in their books at any given point. So why should banks, maintain a huge amount of balance with the central bank, plus also maintain an internal liquidity ratio? Why should they be doing that? Yes, no?
So am I audible to you?
Yeah, Deepesh.
So CRR is the ratio which is sent by the banks to RBI by daily basis
Yeah, but why is the question? Why are they sending the money?
because of they has to um I'm not understanding that.
Sorry?
Sir, because there is a rule that they wants to send some money by daily basis is the certain rate of percentage set by the RBI.
Yeah, I know, but why should they? The thing is, in college, you guys are just told what it is, but you don't know why they do it,
Sir,
right?
for controlling the money supply in the market.
For controlling the
Hello.
inflation rate also.
Okay. One thing is, okay,
For
supply of money in the market. Now, the other thing is that, have you guys heard of the term lender of last resort?
so there is background noise, sir.
Huh. Have you guys heard of the term lender of last resort? Right? All of you would have heard of the term lender of last resort. Yeah. So what happens is that when you go to RBI, the money that you have kept, right, they're going to lend that money to you, right? So that is one of the reasons. So apart from maintaining enough money in the financial system, one of the other things is that when you go to RBI and you want to borrow money from them, right? You are actually borrowing your own money from RBI. Now, why does this happen? Is that, have you guys heard of the term run on the bank? Okay, so when we talk about run on the bank, right? What it means is that suddenly all the depositors, right? They stand in front of the bank saying that I want my money. Now that's what we call as run on the bank. And let's be honest, is that if a bank, if everybody in the country went one shot to withdraw the money, right, the banking system would collapse, right? The banking system would collapse because there is no way banks maintain enough money on their books to meet all the customer demands. Okay, so that is why they have CRR and SLR to help mitigate that risk. Okay, now when we talk about the SLR, right, the bank has to maintain this in their own books. Okay, so basically the liquidity, right, is more to do with near cash instruments like bonds, treasury bills, etc., is what the bank is going to maintain in their own books. In case they don't have enough money, they can sell off all those assets and get money into the company. Okay, is this clear with everyone? Okay, okay. So take a minute and write this down. The interbank lendings, why does it happen? What is CRR and SLR? Everybody done ready? Okay. Vibhor, so as far as I know, right, the main two are your CRR. Actually, main thing more than SLR is the CRR. So if banks don't maintain CRR, right, they are heavily fined and audited and all that bad stuff. Okay, shall we move on? Okay. Now, one of the things that you guys have to understand is that money is not free. How many of you would like money to be free? I know I would. I would retire. What about you guys? Would you like money to be free? Huh? Okay. So, unfortunately, the world is in such a way that money is not free. So, what happens is that if I lend you money, even if I'm a bank, if I'm HDFC Bank and you are, let's say, Yes Bank, I lend money to you, I'm going to charge you interest. Okay? Yeah, right, Vibur. World will collapse. But we actually don't know, right? We don't know if the world will actually collapse. That way, humans are interesting. We can survive a lot of things, but we have to see whether the world will actually collapse. Okay? All right. Let's now look at this. Is that money is not free. Now, if I'm HDFC Bank and you are Yes Bank and you borrow money from me, right? I am going to charge you interest. Okay. Now that interest is profit to me for those number of days that you borrowed. Okay. Now let's look at an example. I loaned you $125 million for 3% for 3 days. Okay. So how does that look like? 125 million, so principal into rate into TCC. True, Vibur, there will be no value of money, true, but then the concept of money was created by humans, right? By man. But now, because we think that there's a value attached to everything. So if we don't attach a value to anything, right, then technically we don't need to pay for anything, right? It's a little weird, but maybe we might move towards that. I doubt it, but that could happen. Yeah? All right. Now, let me be clear is that I loaned you $125 million for 3 days at 3% interest. So what does that mean is that principal into rate into DCC. The principal rate into DCC. Okay, principal into rate into DCC, and that you will have to pay me that amount of money that you borrowed. Okay, and you'll have to return the principal as well. Okay. Now, again, money is not free. So what's the formula? Interest equals principal into rate into day count convention. So I loaned $125 million for 3% for 3 days. So you will have to pay me $31,250 for those 3 days. Plus, you'll have to return the principal as well. Okay. Is this clear with everyone? Money about money not being free and the interest calculation. So we're just doing simple interest calculations. Yes, are we clear? What about the others? Clear? Right. Take a minute and write this down.
So just can you, so I is interest minus principal.
No, not minus. So in I equals principal multiplied by rate multiplied by day count convention.
Thank you.
No, Biswajit. It's considered for all anything. That's your time. You guys have seen the interest rate calculation, right? It's P into R into time. Same thing. So instead of saying time, we're going to call it DCC now. Right? Let me know when you're done and we'll move on. All right. Now let's move on to money market instruments. Okay. So the first money market instrument is what we call as CD, or otherwise known as certificate of deposits. Okay. Now again, this since we're talking about money markets, it's for short-term borrowing and lending. Now you just have to know the features, right? So what are the features of a money market or a certificate deposit? Is that it's transferable to other counterparties, and the interest rates depend on the value and time of deposit. Okay, so the first money market instrument is certificate of deposit. Okay, it's for short-term borrowing and lending. It's transferable to other counterparties, and interest rates depend on the value and time of deposit. Yeah, is this clear with everyone? You just have to, so like how in fixed income, right? We talked about the features of those bonds. Same thing you guys need to know here. So first one is CD. Now it's very similar to an FD, but the main difference is that in a fixed deposit you cannot transfer the FD to others, but in a CD you can. You can transfer the CD to somebody else in the market. Okay, are we clear with this? Okay, so the next one we're going to talk about is what we call as commercial papers. Okay, commercial papers. Now, commercial papers are issued by high credit rated companies. They are unsecured, okay, and they're a form of a promissory note. They're a form of a promissory note, and they're issued in denominations of $100,000, okay, and they're issued from 1 to 270 days. Okay, so there is a they can even do more than 270 days, but if they have to do anything greater than 270 days, right, they have to take regulatory approval. Okay, and they're sold at discount and redeemed at par. Okay, and can be transferable. Okay, so these are some of the features of commercial papers. Okay, so take a minute and write this down, and then we'll move on.
Sir, what is issued in the denominations of 1 lakh? 1 lakh quantity on
No, no, no.
price.
The face value. The value of the commercial paper will be issued at denominations of 100,000.
Okay.
Okay, let me know when you guys are done. Okay, so are you guys clear with the first two? Okay, the certificate of deposits and commercial papers. Okay, so CDs are transferable to other parties, and the interest rate depends on the value and time of deposit. Right? And we talk about commercial papers, they're issued by high credit rated companies and they are unsecured. It's a form of a promissory note. Now, what does a promissory note mean? It means an IOU. That means I owe you money, right? And it's issued in denominations of $100,000. Okay. All right. One thing that I want to tell all of you guys. Okay. Um, when we talk about numbers, right? Please be careful on how you pronounce it. Okay. See, technically, I think it was Deepesh, if I'm not mistaken. He said that. I mean, he pronounced this as 1 lakh, right? Now it's not wrong, but it's not right either. Okay. So if there was a rupee sign in front of it and you said 1 lakh, then that's fine. But when there is a dollar sign or any other currency or any other this thing, right? This is called as 100,000. Okay, so you guys need to. So I don't know why specifically in India we use the lakh and crore system, but the rest of the world uses 100,000, 1 million, 10 million, 100 million, 1 billion, like that. So you guys need to know that. Now, if you don't know it, it's not difficult. You just just write out the numbers and you write how much it is next to it. Okay. But please, in your interviews and all of that, right? Don't say 1 lakh, 10 lakhs, 25 lakhs, 1.5 crores, 70,000 crores. It doesn't make sense to people. Okay. Like one of the questions that happen at Morgan Stanley, right, is that they ask you to flip your resume over and they ask you to write uh, from 1 to 1 billion. Okay. Uh, and they ask you to name it. Okay. So what do I mean by that, right? So they'll ask you to turn over your resume and say, okay, this is 1. Okay. Then they ask you to do tens. So this is tens, hundreds. Okay. I know it sounds really silly, right? But uh, there are people who have failed in this. So up to 10,000 is also fine, right? 10,000 is fine. But from here, this is going to be 100,000, okay, and not 1 lakh, okay. But so if you guys are not clear with this, please make sure that you're clear, right? So then after 100,000, then it is 1 million, then 10 million, then 100 million, then 1 billion, right? So you guys have to be clear with stuff like this, okay? Otherwise, you might get rejected in your interview, okay? All right. Any questions on this, on CDs and CPs?
Sir, it is issued in denomination of 100,000s. Then the
Yeah.
face value is under the currency of US or rupees of currency of India.
Sorry, I didn't understand.
Sir, it is under the dollar, $100,000. or
Yes,
100,000 rupees? Okay.
dollar, not rupee. Otherwise, I would put rupee. It is in dollar.
Okay.
So you got to understand one thing: Indian markets, right? It's still a very conservative market, and they don't do a lot of. I mean, they do it, but it's not as big as the U.S. markets and all that. So largely, we're talking a lot about the stuff from U.S. market perspective. Okay, everybody done writing? Okay. So the next thing that we're going to talk about is what we call as a repo agreement. Okay, a repo agreement, otherwise known as a repurchase agreement. Okay. Now, one thing is a repurchase. So don't confuse repo agreement with repo rate and reverse repo rate. That's sorry, sorry. So we're talking about repurchase agreements. Okay, we're not talking about repo rate and reverse repo rate. So repo rate and reverse repo rate is different, and repurchase agreement is different. Okay, is that clear with everyone? Jackson, it was with fixed deposit (FD). So are we clear? What we're talking about now is repurchase agreement. Okay. Now, what is a repurchase agreement? Is that a repo is an agreement that a borrower sells a security with an agreement to buy it back in the future. Okay, a repo is an agreement that a borrower sells a security with an agreement to buy it back in the future. Okay, now think about it this way: if I want to borrow money from you, I have to sell you a security. Okay, now what is a security generally? It is generally government bonds. Okay, now why do you think government bonds are given as collateral? Why do you think? So listen to the definition carefully, right? So a repo is an agreement that a borrower sells a security with an agreement to buy it back in the future. Okay. Now that security that is given, so if I'm borrowing money from you, I'm going to give you a security. Now that security generally is a government bond. Okay. Correct, Anurag and Saurabh. Okay. Is that why will I give you a government bond? Is that probability of a government defaulting or failing is very, very low. Okay. So what does it do? It reduces default risk. Okay. Now, apart from the security that I give you, I have to give you something called as a haircut. Okay, you heard that correctly. Haircut. I think a lot of us need haircut now. Once the lockdown is done, or anybody who was brave enough to do haircut at home. Yeah. Okay. All right. Very good. Okay. So a haircut is included. Now, what is a haircut? Is that it is a percentage value of the collateral in the market. Okay. Now, what is, and we'll talk more about it, but basically, it is a haircut is given on top of the security that I have given you. Okay. Yeah. Okay. Now, repos can be done with central banks to control the supply of money in the economy and to control inflation and deflation. Okay. Now, what happens is that when do you use a repurchase agreement is that during emergency situations where other banks, so for example, when Yes Bank, right, they were financially struggling, what happened is that a lot of the so they to get liquidity into the bank, right, they might have done repo agreements with the central bank. Okay, so that's why it's very, very important. Okay, or if there's a liquidity issue in the market. Now, what does that mean is that if they have, if their clients are not paying or if they don't have enough money on their books, right, then they can do a repurchase agreement. Okay, don't worry, I'll give you guys an example, but for now, write it down. Write down the definition and what it means. Okay, everyone done? So don't worry, I'll give you an example, but are you guys clear? Have you understood what these words mean, the definition at least? Yes, no? Guys, can you hear me? Okay. I thought you all went off to sleep. Okay. So are we clear with what is a repurchase agreement? Okay, don't worry, I'll give you an example and we'll go through it. But did you guys get the idea? Okay, so it's an agreement that a borrower sells a security with an agreement to buy it back in the future. Okay, now why give the security? It's to reduce a default risk. Okay, all right. Now let me show you guys an example. I'll come to that. Give me 2-3 minutes. I'll come to that percent. What that haircut means. So haircut reduce the value of the asset. Okay, rather the haircut adds to the value of the asset. Okay, one second. I'm just pulling the example.
Sir, how can it increase the value of an asset?
Hang on, I'll come to it. Give me one second. Okay. Now, when we talk about repo agreements, right? Now, I've taken an example. So this is like a real life example that I used to do when I was working in SocGen. Okay, so we have Society General Hong Kong and we have HKMA. Okay, now HKMA stands for Hong Kong Monetary Authority. Okay, now Hong Kong Monetary Authority is basically the central bank of Hong Kong. Okay, is clear on that part? Okay. Now, let's say, for example, Society General Hong Kong wants to borrow $100 million, and HKM and they come to HKMA to do that, right? So what happens is that HKMA will lend them $100 million. Is this clear? So SG Hong Kong is going to borrow 100 million from HKMA. Is that clear?
So please recap, please, sir. Please recap, please.
Sorry. I
The
didn't.
repo agreement, please. Am I audible to you?
You're breaking up.
Now I am audible to you?
Yeah.
Yeah. So please, can you recap the repo agreement, please, once? I've lost
Okay.
my connection. That's why I.
Okay. Fine.
Okay.
Okay. All right. So again, when we others can hear me. Okay, give me 1 second. Okay. Now everybody should hear. Okay. All right. So when you talk about repurchase agreements, right? It's generally done during times of emergency, or if there's a liquidity issue in the market. Basically, you're not able to get money into the bank. Okay. So what is a repurchase agreement? Is that you're going to borrow money from somebody in the market, and what you're going to do is that you're going to sell a security. Okay. And that security, what you're doing is that you're agreeing to buy back that security sometime in the future. Okay. So a repo is an agreement that a borrower sells a security with an agreement to buy it back in the future, and it's to reduce default risk. Okay. So we'll talk about it. So now let's look at the example here, right? So ASG Hong Kong wants to borrow $100 million from HKMA, which is a central bank. Okay. Now, what does SG Hong Kong have to do? They have to give $100 million in government securities. Okay. And that's what we mean by collateral. Okay. So first just focus on what is SG Hong Kong doing, then we'll come to HKMA. Okay. So clear. So SG Hong Kong wants to borrow 100 million. So they have to give 100 million in government securities. Now that government securities acts as a collateral. Now, can anybody tell me why should you give a collateral? Why not just simply borrow?
To reduce the risk of default.
Yeah, but in interbank lending, see guys, that's the obvious thing. My question is a little bit more than that. Think about it. So in interbank lending, we did not talk about collateral, right? Now, why are we talking about collateral here? See, counterparty risk is the obvious answer. But my question is, in interbank lending, you didn't give collateral, but why in repo you have to? Any idea? Think, think. Whose money is this? If you're talking about the central bank of a country, whose money is this? Government. But in turn, it's our money, right? See, the government collects taxes and all of that through us, right? So it's largely our money. So that is why you have to give collateral, because you are taking public money. Okay, is this idea clear? Why you have to give collateral is you have to, because it is public money. Okay. Now let's understand one thing, right? Now this government securities will they keep changing in value or will they remain constant? Okay, they'll keep changing in value because see, if I borrow 100 rupees from now, that 100 rupees will not change. But if I give you like a gold piece, that gold price will keep changing on a daily basis, right? So that is why you have to give what we call as a haircut. Okay. Now, what does that mean? One second. Okay. Now, haircut again is the percentage of the collateral given in cash. Okay. So what will happen is that, for example, 10% of 100 million I have to give in cash. So in total, okay, so I will give 100 million in government securities. Okay, GS is government securities plus $10 million in cash. Now this $10 million in cash, right, is haircut. Now, why am I giving that? Is because the collateral that I've given keeps changing value, right? It keeps changing value, and because it changes value, right, it's a risk to you. If I'm borrowing money from you, right? So imagine that if I borrowed, let's say, money from you, and I gave you an asset that has a depreciating component, would you be safe, right? So that is why you have to give a haircut, which is above the value of the collateral. Correct, sir. Right. So, so when we look at this, right? So if you look at SG Hong Kong, what are they doing? They're going to borrow 100 million. They're going to give 100 million in government securities as collateral. Plus, they're going to give a haircut. Okay. So all of that gets transferred to HKMA. Okay. So what will HKMA receive? 100 million in government securities plus a haircut. Is this part clear? Now, Vibhor, do you understand why haircut is required? Yeah.
Sir, haircut is included in the 100 million
No, no, it's
or
separate. It's separate. See, look at the last line. I've said 100 million plus 10 million in cash. Yeah, so the security, because it reduces value, right? You have to give haircut. So the way I put it across is that you have to add the haircut to the collateral. Okay, is it clear now? Okay, so what we just talked about is what we call as a repo agreement. Okay, now this is the first leg of the transaction. Exactly, Vibhu. So that's a very simple way of understanding it is that you're giving 110 of something to get 100 of something. Okay. All right. So this first leg of the transaction is called a repo agreement. Okay. Now the next leg, okay, is what we call as the reverse repo agreement. Okay. Now in reverse repo, what's going to happen is that SG Hong Kong will return the $100 million plus interest. Okay. So SG Hong Kong will receive 100 million in government securities plus the haircut. And HKMA will return the 100 million in government securities and haircut. And HKMA will receive 100 million plus haircut. Okay. So again, let's look at only SG Hong Kong. So what will SG Hong Kong do? They will return the $100 million. Since money is not free, you'll have to pay interest. Okay, so that goes to HKMA. So you look at it crossways, right? Now HKMA will receive the 100 million plus interest. Now what will HKMA have to do? They'll have to return the 100 million government securities and haircut to SG Hong Kong, and this is known as a reverse repo. Okay, is it clear with everyone?
So will there be any possible interview questions for this? And if so, how would they ask us? So,
Explain repo. Explain repo. What is a repurchase agreement? That's it.
all right, thank you, sir.
Okay. Now, are we clear with all of this? Okay. So take a minute and write this down. Yes, sir. So that's what I mentioned, right? Repo can be used to control the supply of money in the economy. All right. Guys, can I scroll down for the rest of you? It'll vary. It's just an example. Okay, let me know when you guys are done. What do you mean, Saurabh? I didn't understand. Prohibition of what? Yeah, so yeah, treasury bills again because they're the safest, right? So here, right, why they will not accept equity or any other form of security is because there's a higher risk of default involved. Okay, and plus you're talking about public money, so they have to have the safest possible securities. Okay, everybody done writing? Others? Okay. Are we clear with this? Repo? Okay. Now, let me give you guys a real life incident. Okay. So, no, mutual fund units, is that what you're talking about, sir? No. So, see, again, security is largely government securities. You cannot use mutual fund units to supplement a treasury bill. Okay. All right. Okay. Quick real life incident. Okay. Now, this happened a few years ago at an investment bank. Okay. Now, you all understood repo, right? Or at least I hope you did. It's clear, right? Repo. Okay. Now, see, this is why it's very important that you guys understand basics. And you guys are largely freshers, 0 to 2 years, 3 years, or you're all freshers. Okay. They are going to ask you only basic questions. They're not going to ask you calculate this, do that, do this, and all that, because that's not what operations does. They want to know whether you understand things and you can do the job that's provided to you, right? Now, let's look at this. So, this is a real life incident that happened, okay, in one of the investment banks a few years ago. So, the front office, okay, the front office, the trading desk, right? They immediately had to borrow money from a central bank of one country. Okay, they had to immediately borrow it. So what they did was that they informed the fixed income team. Okay, so you have a fixed income team. Now, why fixed income? Because they are the ones who do all the releasing of the bonds and all of that. Okay, now, everybody is on a group chat. Okay, you have front office, you have fixed income security team, back office team, and you have the treasury department. Okay, now again, the treasury department, they manage the money for a bank. Okay, so all three are in chat. So the front office guys say, "Hey guys, please initiate repo with the central bank." Okay, so the job of treasury team is to receive the money and then pay back the money. Okay, that is the job of treasury. Now, what is the job of the fixed income team? Is to release the government securities and haircut, right? Now, what happened was that once the repo was initiated, so you have to do it on the central bank system. So it was initiated by the treasury team. So immediately the money came to the account, okay, and then the bank ended up using it, and then the bank paid it back the same day with interest. Okay, the bank paid it back the same day with interest. Okay, and case closed for that day. The next day, when everybody comes to office, right? There was a major issue. Now, what was the issue was that the central bank called up the front office guys and they have screamed at them for a good 45 minutes. Okay. Now, why have they screamed at them for good 45 minutes is that the person in the fixed income settlements team who was a new joinee, okay, and that person did not know what a repo agreement was, and that person did not release the bonds and haircut to the central bank. Now, here's the funny thing. When the front office person asked, guys, is everything completed? Treasury said yes, and the fresher who does not know anything says yes. Now, if somebody tells you that they've done their work, what does that mean? Like they have done their work, meaning they have released the bonds to the central bank, right? But the person who was on the team, right, did not know what a repo was and didn't understand it, forget even knowing, didn't even understand what was being said, but just said yes and got it done and said that, yes, I've done it. But the next day, the implication was so big that the bank was fined a lot. I think it was fined some 5,000 or $10,000 for that mistake. Now, isn't that a silly mistake, right? So that's why I keep reiterating is that you guys need to know your basics. Okay? If you cannot, if somebody calls, so, and here's the advantage you have, right? So you're learning through us and through me. So if somebody comes and tells you, do a repo agreement, it has to flash into your mind, okay, this is what is a repo agreement. Because what happens, a lot of students, right? I noticed that you'll only study for the next few weeks, few months until you get placed. After that, you will not study and you'll forget. But I'm fine with that. But you got to understand that these things, they don't change in the market. And tomorrow, if you're in a situation and you don't know what to do, right, you will cause a mistake to the company, you will cause a financial loss, and you might even be fired for it, right? Now, could this have been avoided? And how could it have been avoided? Very simple. What is repo? So at least we would have the person would have been laughed at, but they wouldn't have caused a $10,000 mistake, right? And why was the central bank angry? Right? Why did the central bank was angry? Is that they gave an unsecured loan to a financial institution in time of a emergency, right? Yeah, Vibhor. So here's the thing, right? I'm more than happy if they join, but then you have to remember all this stuff even when you're working. But generally, what happens? So largely, since I'm based in Bangalore, right? I still have all my friends and my ex-colleagues working in investment banks. So initially, the feedback is good about Imartka students, but after that, right? They're like, oh, you guys forgot this, they forgot that. A little bit of a negative feedback also comes in, right? But what I teach you, right, if you can remember it for at least next 3 to 5 years, right, you are going to be very, very well off in your career. Okay. All right. So this is what can go wrong, and it could have easily been avoided. Could have easily been avoided. Yeah. Yes, so you will have a lot of lessons like this, right? You'll have a lot of lessons like this, and unfortunately, you will all make mistakes, and you will all have to face people like me who are going to be, well, I wouldn't say nice to you, but we won't be harsh as well. But you will also have to get, you'll have to what do you call it, be punished for it as well, right? Because see, I'll tell you one thing, most often than not, the mistakes that happen in operations are silly mistakes, not the big mistakes. And that silly mistake is what costs a lot of money. Yeah. And then when we go into level 2 and all of that, right, I'll tell you guys some of the other stories that I've experienced, some of the mistakes even I have made. Even I've made quite a few mistakes, right? So all of that has happened, right? Okay. Now, are we clear with repo? Okay. All right. Now let's talk about treasury bills, otherwise known as T-bills. Okay. Now this is issued by the central government. Okay, through the central bank. So central government gives says that I want to borrow money. So it goes to RBI. RBI is the one that will borrow the money from the market and give it to the government. Okay. So T-bills are sold at discount and redeemed at par. Now, what does that mean? Is that there is no interest component. Yeah, there is no interest component to this. So what happens is that if let's say the face value is $1,000, they'll discount it to 950, and that is all. That's what you'll have to pay, 950, and it is issued for 30, 90, 120, and 180 days. Okay, usually 30, 90, 120, and 180 days. Okay, is this part clear with everyone? Okay, take a minute and write this down. Yes, Bisoji. So it can treasury bills can be used as collateral, government bonds, etc. Okay. Okay. Now, when we talk about the treasury bills, right, or the T bills, since it's issued by a central bank, right, what happens is that uh, it has to go through an auction process. Okay. Now, an auction process is a fair mechanism rather to issue out all the securities. Okay. So when we talk about the treasury bill auction process, right, there are two types of bidders. Okay, what we call as a competitive bidder and a non-competitive bidder. A competitive bidder is like in an investment bank and a commercial bank, and they bid both on quantity and price. Okay, and then you have non-competitive bidders, which is retail investors and individuals. Okay, and they only bid on quantity. Okay, so again, to reiterate, the treasury bill goes through an auction process. There are two types of bidders: a competitive bidder and a non-competitive. Competitive are IBs and commercial banks. They have to bid both on quantity and price. And non-competitive bidders, are retail investors and individuals like you and they only have to bid on quantity. Okay, is this clear with everyone? Is this clear so far? So when we talk about the auction process, there are two bidders: competitive, non-competitive. Okay. Now, largely what we're going to do is we're going to talk about the auction process in the US. Okay. Now, in the US, they use a system called as TAPS. Okay. It stands for Treasury Auction Automated Payment System. Okay. Now, what happens is that all the bids, okay, will be entered into TAPS. Okay. Now, the first bidders will be non-competitive bidders. Okay. So the first set of investors will be non-competitive bidders, and they will put in all their bids. Okay. And now please remember that they only put in quantity and not price. Okay. Once the non-competitive bidders are done, then the competitive bidders will put in the bids. Okay. Now, what happens is that the TAPS system, it's a automated system. What it does is that it looks at or it prioritizes highest quantity and then price and allocate those securities to those only with the highest quantity and price. Okay. And this is known as discriminatory pricing. Now, if when you look at this, right, competitive bidder has to give both quantity and price, but a non-competitive bidder has to give only quantity. So how will we determine his price is that the last competitive bid price will be the non-competitive price that the non-competitive bidder will have to pay, and that's known as a stop price. Okay, I'll explain again. Please listen carefully. It's not difficult. Okay, so it has to go through an auction process. Everybody knows what an auction is, right?
Sir, please explain option. I don't understand what is option.
Dipesh, have you ever seen IPL auctions?
Sorry?
Have you ever seen an IPL auction?
No, sir.
IPL, you've not seen IPL auction. How they get the players?
Okay. It's just like a bidding.
Yes, exactly. Bidding.
Okay.
Yeah. Same logic.
Okay, thank you.
Sure. All right. So now what's going to happen is that all the bids will be entered into TAPS. Now TAPS stands for Treasury Auction Automated Payment System. Okay. Now the first bidders will be non-competitive. Now please understand, non-competitive will only give the quantity and not price. Okay. And then what's going to happen is that once the non-competitive bidders are done, then the competitive bidders will put their bids. Okay. Now, once all the bids are in the system, right? The system will look at highest quantity and then price. Okay. They're going to look at the highest quantity and allocate the securities to only those with the highest quantity and price, and this is known as discriminatory pricing. If you remember, we talked about discriminatory pricing in equity. So basically, the allocation of the treasury bill will go to the people who have given the highest quantity and price. Okay. Now, how do we determine what the non-competitive bidder will have to pay? Okay. So what we'll do is that the competitive bidder who puts their bids, right? The last person that puts in that competitive bid, okay, that is known as the stop price, and that stop price is what a non-competitive bidder will have to pay. Okay, now I'll give you an example. Now let's say that there is investor one, or let's say, okay, now let's say that T bills that I want to issue is 100. Okay, the face value of 1,000. Okay, face value 1,000, and I want to issue 100 T-bills. Okay. Now, please realize that this is when we talk about T-bills, right? It's issued at discount, right? So let's say investor one puts in 990. So let's say we'll take the non-competitive bidder, right? So let's say he wants 10 bid, 10. Second investor wants 30, and the third investor wants 15. Okay, so this is all your non-competitive bidding. Okay, now let's look at the other side. Is that now the competitive bidders have come in, and these guys are like, I want to buy 50 at 990, and the fifth guy comes in and says, you know what, I'll buy 80 at 995. Okay, so they will come with different prices. Okay, now let's say that after everything is done, okay, we still don't know what is the price, correct? So in this case, we're going to use number 5 as the stop price. Okay, so this is what the last competitive bid price. Now this 995 is what these guys will have to pay. Okay, is this clear with everyone?
Sir, so the price of the stock is the decided by as per the competitor bidders for non-competitor bidders.
Yes.
It's generally said that. Okay, thank you.
What didn't you understand, Ganesh?
Rakshit, are you able to hear?
Yeah, go ahead.
Yeah, I'm just confused with the example actually. So
Okay.
why? Because since you said like first person can take like he's opting for 10 quantity of 10 at face value of 995 like
No,
at the
no.
discounted
Once again,
price.
once again, once again. See, the first three are all non-competitive bidders. Okay, now
Okay.
non-competitive are you and I, retail investors, individuals, and we can only give quantity. We cannot give price.
Okay.
Okay. So if you're, let's say you are a non-competitive bidder, okay, and let's say Saurabh and Annette are also non-competitive bidders. So you guys are only giving quantity. That's it.
Okay.
Okay. Now, how do we figure out your price?
Goes to the competitive bidder like highest
Yeah.
price.
Yeah. So the guy.
Okay.
So now let's say that I am competitive bidder number 5, where I want to buy 80 treasury bills at 995. Now
Okay.
that is so this is the last competitive bid price, the last price. Okay, so this is
Okay.
known as a stop price, and we will use this 995. So this 995 is what you're going to pay me.
Okay.
Okay, or pay to the government rather, not me. Pay to the government. That's what that means.
So, okay, let's just say, imagine. So person number four, he
Hmm.
just wants only. I mean, he's going for the quantity, and the price is 995. I mean, let's say he is highest with a bit less shares than the fifth person.
Okay, no, so that's what I'm saying is that, see, we will not consider number four. We are only looking at the last competitive bid. So imagine
Okay.
there are millions. Let's say there are 100 people, or let's say there's 23 people in this online class. The 23rd
Mhm.
person, that price is what we will take.
Irrespective of the quantity and
Yes,
price.
yes, exactly. Because
Okay.
it's the
Uh,
last. See, look at what it says: a stop price. It is the last competitive bid price. That is the price that non-competitive bidders will have to pay.
okay. Got it.
No. All right.
Thanks, Arjun.
Sure. No problem. Okay. Are we all clear? Yeah, so that's what I'm saying, right? It's the last competitive bid price. So the last person in line, whatever price they are quoting, that is the price that non-competitive bidder will pay. Okay. All right. That's it for today. So money markets is a slightly smaller topic. Okay. So we're done. Let me take attendance. Okay. Give me one second. Let me take attendance, and there's a few announcements that I have to do. Okay. Actually, I'll stop your recording as well.